Good morning. Today's lesson is under IAS 33, and the topic we'll be looking under IAS 33 is share repurchase or buyback shares. Share repurchase or buyback. So now when we say buyback, what does it stand for? What is the meaning of buyback? Buyback is when company decide to buy back its own shares from the open market. You see, so it is when a company decides buy back its own shares from the open market. That's what you call buyback. So assuming a company on 1st January 2026 outstanding shares 100,000, and on 2026 new share issue 50,000 on 1st October 2026 share repurchase and cancelled was 30,000 required. Calculate the for the weighted average number of shares. All right, so you are confronted something like this. So company have decided to do share repurchase. So let me give you how share repurchase is done. You know the process. First, you will start with if your period when the share was bought, then the number of shares available, and then when the month it was purchased. If there's any adjustments you do, then you weight it. The outstanding shares, the question is how much? So it's 100,000, right? So when was it purchased? It was purchased on 1st January 2026, 100,000 shares. And the new share issue, it was purchased in April 2026. And how much was bought? Let's check it. It was about 50,000. So when we are done there, you sum them up. So here we give it 150 shares. And they said that in October there was a repurchase of these shares and cancelled. One was that it was made on 1 October 2026. That is what I did up there. You can see it yourself. So that is what you have here. So how much was repurchased? 30,000 and cancelled. Then you less it. So when you less, what do you have? You have 120,000 shares. So this is what the total shares at the end of the counting year 2026. Now, when you are done, then you do the apportionment. Here is from 1st January to April 1st, it was 3 months. And then from April to October is how many months? April, May, June, July, August, September, which is 6 months. Now the balance left, which are outstanding. This one is how many months? That from October to December is 3 months. So when you are done, then you as usual, you do the apportionment and then you weight it. Alright, so you have first outstanding is how much? It's 25,000. Second outstanding is how much? 75,000. And then the last is 30,000. So when you sum them up, what do you have? So total you'll have 130,000 shares. So this is your this we can say points. This is what you call share repurchase. This is what you call share repurchase. Now, why do companies repurchase shares? Why do they do repurchase? Or why repurchase? One, they can do repurchase on this reason. One, to return excess cash to the shareholders. Right. Now, have you seen this instance? We realize that this 30,000 will be repurchased by the company, and the company will pay cash to the shareholders. That's why we say return excess capital to the shareholders. So the moment the company decided to sell so repurchase. So they decided maybe the company has excess cash to spare. The excess cash is 100,000, right? And they are repurchasing 30,000 shares. So they'll pay 100,000 and they would take back 30,000 of their shares. All right. So two, there's a signal that management believes the share is undervalued. What does this mean? The share the share is undervalued. You understand? So here, listen, the management of the company has what? They have one, the insider information of what? Of the company. They are what? They have insider information about the company. So if they have insider information about the company, right? So they can infer that when they have what? They have information about the company, there's likelihood that this company can what? Make a gain in the what? In the near future. If the company is going to make gain in the near future, a rational human being will what? Will buy back what? The shares. What am I saying here? You are running a company. So assuming on 1st January 2026, share price is what? Is maybe 2 cedis. Now you have insider information about the company that in a 6 month time, the value of the company is going to what? Is going to up, is going to go up. Maybe you have envisaged that maybe on a 6 month time, the value of this share, because when the company expect to what? To have gains in the company, it will increase the value of the company. So if it will increase the value of the company, what do you think the unit price or share price of the company will be? So for now, the unit price of the share is 2 cedis, but they believe, so they have a signal that this very 2 cedis in the near future, which is 6 months, the share price of the company will shoot from what, 2 cedis to 4 cedis. So at this current price, they see that the the current price is what? Is undervalued. So for that reason, what they will do is that, okay, let us buy, they will do what? They will do repurchase of what? Of shares at what? At 2 cedis. So they will buy it back. So when the company finally gets value, the share price will also increase. So when the price increase, what do you think will happen? When they reissue the share back into the company, it will increase their liquidity, or it will increase their what? Their cash. That is the meaning of what? The signal of what management understand. That's the meaning of signal that management believe the stock is what is undervalued. The third reason why they do that is that they buy back their shares to reduce the number of what? Of their shares outstanding. Their shares are which will increase as the earning per share. What does this mean? What this means is that if a company make profit, at the end of the account here, the profit of the company is maybe 100,000. So this is maybe as at the 1st January 2026 visits, and then the shares of the company is 500,000. You realize that the earning per share or basic earning per share is going to be what? Is going to be 100,000 over what? Over 500,000. Okay. So earning per share is going to be 0.2. Now, if they want to what? Increase the value of what of the shareholders. Yes, the company can decide to do that so that they can what? It can serve as a motivation to the existing shareholders. They can say that, okay, let us motivate our shareholders because how much they are what they are getting on their share is not really something that is encouraging. So let us do this. So they can decide that, okay, let us buy back share repurchase of what? How much? 300,000 shares and what? And cancel. So when they purchase it, what do you think will happen? So here you have your shares, outstanding shares was how much? 500,000 shares. Okay, let me make this one maybe 30,000, or let us make it 100,000 shares. They are buying back 100,000 shares. So when you less 100,000 shares from 500,000 shares, what do you have? You will have what? Outstanding shares of 400,000. Now, with the same, so let us make it maybe 1st January 2026, they did repurchase. So what do you think will happen to the basic earning per share? So you have what? Earning per share is equal to what? The profit is how much? The profit is 100,000. So you have what? 100,000 divided by what? By 400,000. What is your answer? So you have, so that gives you what? 0.42. So you realize that the earning per share has what? Has increased a bit for the shareholder. So this is a form of what? Of incentivizing the existing shareholders with the buyback. Now let us look at the fourth one. So the fourth one is also what you call offsetting the what? Offsetting the dilution share option. All right. So what does this mean? Company may decide to buy back their shares in order to what? In order to offset the employees' dilution. Right? What does it mean? In the first place, when we say share option, what do you mean by share option? Share option falls under IFRS 2, right? So it is in the form of what? Equity settlement to the existing employees, right? So what this means here means that the company can give the directors or employees of the company maybe share option of 100 million cedis. You see, what this means here is this 100 million that they are giving to the directors or the employees of the company, it will what? It will be converted example. So let's use this one as an example. So they are saying that okay, we are giving you share option of what 100 million. Okay, but you will exercise this share option. Exercise price. We are giving it to you at the price of let's say 1 cedi 50 pesos. But the market price of this share is how much? Is 2 cedis. Right. So we are giving this share option to this our directors or the employees of the company at this. So when they decide they opt to what exercise it, then they will what they will pay at a what at a reduced price. They also say that okay, so you're giving them this to what to buy at this exercise price. This is what we call share option. So and this will affect the equity shares that the company is holding already. What happens here? What happens here is this. So you first what calculate your dilute or your dilution in percentage. So what is the formula? The formula is what? The market price of what? Of the company share minus what the exercise price that they're giving it to the what? They're giving to the the workers over the market price. That's what times 100%. So what happens? So you pick the market price, which is 2 cedis minus what? 1.5, right? All divided by market price, which is 2 times what times 100%. What do you have? So what you will have here is this. So what you have here is what? Is 25%. Now that you've had your 25%, now you can use this one to determine what you determine the share option in share options equity share or the number of what equity share in the share option. So how do you convert? So what here mean is that after you've done the dilution percentage, then you convert the share option given, which is 100 million to what? To number of shares. So how do we do that? You pick the share options as given here. What here? It's 100 million, right? Okay, so when we pick 100 million, so share option 100 million. Let me make it maybe 100,000. Okay, so when you pick this 100,000, then you multiply by what? You multiply that by what? By percentage in dilution, which is what 25%. So when you do that, what do you have? So you have 100,000 multiplied by 0.25. That gives you how many shares? So this is what the shares, that is what 25,000 shares has come in. So this is what is going to dilute the already existing shares. So let me use the previous example that I was using. So now let's assume after the share repurchase, we already have our outstanding shares worth to be 400,000. Have you seen that? Okay. So when we pick it, what do you see? So you see that you have what outstanding shares of what of 400,000. Then you will add the shares from share option, which is what 25,000. What do you have? So you will have 425,000. You see, so this becomes your wins that you have. Now check this. Now you cannot calculate your basic. You cannot calculate your what we call this one diluted earning per share because of what the share option. At least you've diluted the already existing shares of 400,000 by what by the share options. You see, you've given the directors what share to become equity owners of the company. We call it dilution. So when that happens, it will increase the number of shares of the company. Now you divide it by what? By the profits or over the number of shares the company has. And the profit in the question as I did is how much? The profit is 100,000. Now, when you pick 100,000, you divide it by 425,000. What do you have? Realize that you have 100,000. You will get what? 0.23. What this basic earning per share? When I first calculated, what did I get? When I started calculating it, you see, like when we are doing the reducing number of shares, one of the reason point three, reduce the number of shares in outstanding, which increase earning per share. Okay, so I use this one as an early example. What did I get? I go to 0.2, right? I use that one as a beginning of, okay, 0.2 was what you got. So the company decided to do what? Repurchase of what? Of shares. After the repurchase of shares, the basic earning per share rose. What you have you seen that? It went up to what? To 0.25. You see, this is what at least there's what the share value has increased after repurchasing. So when you repurchase it will reduce the number of shares and it will increase the basic earning per share. Now what you after that, when there's a dilution of what? Of shares. So dilution of share where there's what? There's a share option. So after the share option, what happened to basic earning per share? Watch it. What happened to what? Basic earning per share after dilution? What happened? See 0.23. Have you seen that? Your basic earning per share has what? Has reduced after the what? After the share option, because you've increased the number of equity shares, so it will surely affect the basic earning. So this is one of the reasons. So when that happens, the final the fourth one, when that happens, it will dilute the what? It will dilute the basic earning per share. So in order to what? In order to reduce the effect, that's what say offset dilution from employees share option. So in order to offset the dilution employees option, what do you do that? You have to what? You have to repurchase, right? Repurchase part of what? Part of shares in what? In issue. Now after the dilution, your outstanding shares stood at how much? Outstanding shares stood at 4,425. Company may decide to do what? Do repurchase and cancellation of what? Of its shares in what? In the open market. So when you do that, what happens? So when you decided to repurchase 20,000 shares from the market. So when they repurchase, what happens? So you will have it this way. So your outstanding share is 4,250,000. Then you did what? Repurchase, which is how much? 20,000. So how much share you have? You have 45,000. So what do you take for? So you have your basic earning per share is equal to how much? 100,000 revenue or profit over what? 4. You will have 0.246. Now watch it. After the repurchase, after you've introduced all the share options and you repurchase back, so compare the two. After share option, your basic earning per share is 0.23. Now after your fourth, you've repurchased to offset the share option, it has now moved here. Alright, so basically that is the explanation to share option.